we do have to break down this barrier between the high correlation between oil. At least if we can do that, then global investors can see how our economy is doing X oil. And we're not in great shape, but we're not as bad as the world thinks in terms of how the economy is doing and what the potential for a recovery is as well. What else did we learn in 2015? First off, we talked about this a little bit, but the TSX is really not an appropriate benchmark. For those of you old enough, remember when Nortel was 50% of the index and then went bankrupt. It really is just quite a ridiculous index as far as we're concerned to follow. Right now, it's again, even after the decline in energy and metals and even gold over the past 5 years, it's still all about the banks, the trees, and the rocks in Canada. And for most conservative investors, you really don't want 40% of your portfolio exposed to companies in energy, golds, and metals, where their fortunes are not dictated by their own actions. Their fortunes are dictated by global commodities and China and supply and demand elsewhere. So those companies are fine to add diversification, but seriously, it shouldn't be half of your portfolio dependent on outside factors. And I throw the banks in there as well, of course, because interest rates globally in the US do affect our banking system as well. So just keep that in mind. There's nothing wrong with underperforming the benchmark if your benchmark's the TSX, if you have a much more safer, more diversified portfolio overall. It's probably a much preferred situation. You'll hold your stocks longer. You won't stress out. You won't try and swing sectors around, and you'll probably do much better over the longer period of time. What else did we learn? The thing that was perhaps a little bit surprising to me was how wrong investment executives were, company executives were, in terms of their own forecasts. Sure, oil surprised everyone by going down, and the dollar surprised everyone by going down so much. But we constantly ran into companies last year that were completely adamant that their dividend was going to be safe, secure. They'd put it in writing, they'd put it in a press release, they'd talk about it in conference calls, and then they completely reversed course and started slicing and chopping their dividends left, right, and center. Certainly, business conditions change, and companies cannot predict the future any more than anyone else can, but we were just surprised at how vocal they were and how quickly they changed course. And so we get a lot of questions about dividends and whether they're safe, and we just never use that word ever. We might say secure, which is a little bit different than safe, because we've seen too many companies forecast really good things with their dividend and then not deliver them. The easiest solution, of course, for a company is not to talk about their dividend. Dividends are discretionary. They're up to the board of directors. There's no guarantee. They're not safe. So really, if a company says a dividend is safe, just take it with a giant grain of salt, because they really, really don't know what's going to happen in the future, and they can cancel that dividend anytime. And of course, we saw that left, right, and center in 2015, and a lot of people lost a lot of money counting on dividends that were no longer paid, or at least chopped in half or 3/4 or something like that. The other thing we learned in 2015 is if you have debt, your problems are compounded. This is not new, but it was really a situation where investors no longer gave companies the benefit of the doubt. If you had a large debt position, then investors would look at you and say, okay, well, what happens now? How are you going to refinance this $200 million in debt that's coming due in 4 years? And so in a normal type of market environment, investors might look forward and say, okay, here's a company with 4 years before they have to refinance debt. 4 years, the market could change, the economy could change, the debt market could change, the credit market could change, interest rates could change. 4 years is enough time for this company to make amends or deal with investors and deal with finances or make asset sales or whatever to sort of deal with that debt situation. But in 2015, investors basically said, if you have debt, we do not want to invest in you anymore. This is part of what happened during the year. There was a lot of fear going on in the world, and you got a situation where investors were no longer confident extrapolating forward and assuming that things would get better. They just decided that things would get worse. And of course, any company with debt paid the price, and Valiant's the poster child of that. Went from hero to zero in a grand total of 7 months. And if Valiant did not have their debt problem, if they didn't have 30 billion of debt, then it really wouldn't have made headlines. The short sellers wouldn't have attacked it, and it wouldn't have been in the daily news every day. It would have been another healthcare company that had slowing growth, but they could work their way out of the problem if they had a cash-rich balance sheet. So we get a lot of companies or a lot of questions on Valiant, and we basically say, well, why would you put yourself in that situation when you can buy another company with no debt at 7 or 8 times earnings? It just makes no sense. And so, of course, all the oil and gas companies had the same problem, but other companies like GuessLogic found out that too much debt is not going to help them, and that company's actually now bankrupt. So we've said this before and we'll say it again, just be careful on your balance sheets of the companies you buy, because it reduces your time frame, it reduces your chance of getting out of a problem. On the positive side, perhaps more so than in the past four slides, as usual, corporations have a longer time frame than most investors. So you get a situation market to a company than a corporate buyer will. The easiest example here would be Rona, which Lowe's is buying, and they paid their premium on Rona was, I think, 102 or 103% more than what it was trading for in the market. And this one we kind of like as an example because, of course, Lowe's tried to buy Rona 3 or 4 years ago. They were rejected by the case. They were rejected by the Quebec government, but the value was still always there as a takeover. And then 3 or 4 years later, they come by and they say, well, 100% is going to be the price. And of course, in a bad year, 100% premium kind of convinces the case and the Quebec government that maybe it's a good deal to take a profit now and again. And now you've got Rona being acquired by a US company. Capstone was a company that we followed, and it was a bit of a basket case, to tell you the truth. They cut their dividends. They put themselves up for sale and nobody wanted to buy them. You know, it was just they were not growing anymore. But then along comes a foreign company and pays, I think, 45 or 47% more for the company, and that'll be gone as well. Progressive Waste was a bit surprising. There's a company that picks up garbage in North America, and another company decided that its valuation was not what it should be and bought it for a stock exchange transaction. And then just this week, Bankers Petroleum received a takeover bid at 100, I think it was 105% to what the market was trading at. So again, the time frame is key and the valuation is key. But what we've discovered is some of these deals can go at 60 or 70 or 80% premiums, but because of the way the market's gone, they might be still cheaper than these companies were 5 or 6 years ago. So we always like to look at where a company's valuation was, not so much the stock price, but the cash flow and the earnings and how consistent it's been versus what the stock is doing. And you can also often get into situations where companies are actually making more money than they were 3 or 4 or 5 years ago, but their stock prices are half of what they used to be. And those are the names that would more than likely be takeover candidates for the right type of larger corporation. Another lesson from last year is the first dividend cut is never the last. Got some examples up there, but Atlantic Power is probably the easiest example because it's not a energy company. Certainly any energy company like Crescent Point or Surge is going to have their problems, and both of those cut dividends twice. But Atlantic Power is an energy producer, and you would think that it had a little bit more stability in its cash flow and its predictability of earnings and dividends. But no, they cut their dividend, then they cut their dividend again, and then they eliminated their dividend. And of course, the stock did its thing when an income investment becomes a non-income investment. It's obviously fairly painful for the company. So this chart is only, it's only maybe a month or so old. I pulled it up about a month ago for another presentation. It's changed a little bit, but this shows you how bad TSX has been versus the S&P 500. So a very, very big gap, still kind of moving similar in terms of direction, but obviously Canada has underperformed the rest of the world for quite a long time now. That is related to our resources, but it does show you when you overlay that with the dollar. So say, for example, our market, maybe for a particular stock or sector, might be down 25% versus the equivalent global company or US company. You overlay that with a dollar that's 30 or 32% lower than it was a couple of years ago, you get a situation where a foreign company can buy a Canadian company for 50% less than it was 2 years ago or 3 years ago, based on the relative valuation differences in the market and the relative valuation differences in the currency. So we've seen this happen already this year. We imagine it'll happen a lot more with Canada just being acquired by foreign entities until there's some improvement in our market or some improvement in our dollar that changes that scenario. So we think that'll be a very important theme as we go out through the balance of the year. Probably the most painful lesson last year for investors was preferred shares. They were just destroyed, for lack of a better phrase. There was a credit quality issue. People suddenly became concerned about every company, even big, large, stable names like Enbridge saw their preferred shares just killed. Of course, any preferred share with a reset provision got killed because rates were going down in Canada. It was total panic in the sector, and people who were expecting a $22 or $23 preferred share to be nice and stable and provide income saw some of these preferred shares go to $12 or $13. They lost half their money, and at the same time on some of their resets, they found out that they're going to get less income as well from dividends. So it was a really brutal situation. It was a bit of a perfect storm against the preferred share market. We think the preferred share market will do a lot better going forward, but we couldn't believe how many investors asked us about the $25 redemption clause in preferred. So they would see a $13 preferred and say, oh, I'll be okay because it's a $25 redemption from the company. But we had to continually remind people that the redemption is entirely about, it's entirely at the company's option. So there is no guarantee. The only thing that happens in that word is if you have a retractable preferred where it's your choice to put it back to the company, and they basically don't exist anymore because the companies didn't like them. So be very careful on preferreds, but I think overall you'll have a much better year in preferreds than you did last year. I don't really see how it could get any worse in terms of expectations and sort of conditions all conspiring against preferred share investors all at the same time. So I like this chart because investors continue to be irrational no matter what happens. When the market was down, now this is not really a 2015 lesson because it was in January, but in the January period of time, we got dozens and dozens of questions about, I'm going to sell everything because of what's happening in the world, and I can't believe how bad it is in January. And of course, it's always bad when it's bad because the market's down, and of course, everything looks like it's going to zero. And we saw a lot of irrational investors kind of go to cash, sort of abandoning their whole strategy just because there was some doom and gloom in the world and there's some bad headlines and the market was bad. But as you've seen, if you've been watching the markets, of course, there was some rationality returning, and panicking and reacting to headlines is never the right thing to do. So the thing that was interesting last year was preferred shares went down because they were worried about the US interest rate scenario with rates going up, Canada dropping interest rates and maybe moving to negative interest rates down the road. Preferred shares went down because interest rates were going down. So if you think about it, you can't have it both ways. You're either worried about preferreds because of interest rates going up, or you're worried about preferreds because interest rates are going down. You can't really be worried about them because they're going up and down. It just doesn't make any sense. Then of course you get the whole bad news, good news scenario where the market for a while was liking good news when there was good employment, good data, good corporate news. That was good for the market. Then of course people started to worry about the Fed hiking rates too fast, and suddenly good news was no longer good news, it was bad news, and then they started cheering when employment numbers were not as good or housing numbers were not as good, because that meant the Fed wasn't going to raise. So we kind of laugh and shake our heads at that a little bit, especially on the Fed side and the interest rate side. The best thing for investors really in the long term is to have a strong economy. You have better housing, better corporate earnings, better employment, your stocks will do better long term, and you'll have some pricing power, and you'll make way more money than you will if the economy is weak and the market goes up because interest rates are being cut. The latter is really just a monetary move. The former, when you have good consumer spending, good profits, that's sort of a structural move and not a short-term move. So we say bring on higher interest rates as long as the economy can handle it in terms of the employment situation, inflation situation, housing situation, and all the data that the Fed looks at. So we really don't think you should fear higher rates if they're backed up by strong economic news. So right now we're sort of there, we're sort of not there. And then of course we've got every time China sneezes, the rest of the world gets a cold. But we did some numbers last year and learned a good lesson where in terms of the S&P 500 earnings, there's only a 3% direct earnings impact from the China economy across the board in terms of the average S&P 500 company. So really it's just a scenario of extrapolation and valuation, but the actual impact of China is really not as much as you think. It's growing, of course, and in the future, 10 years from now, it'll be much more. But as far as actual earnings impact, it's almost a non-event right now for a corporate company in the U.S. And then, of course, everyone likes to worry about interest rates. I mean, we're at very, very low rates. We have very low inflation. We really think the panic and the focus on interest rates is a little bit overdone. We'd rather take a look at corporate earnings and how corporations are doing. If rates go up 0.5%, bring it on. What else can we pick up from 2015? Well, a lot of people like to beat up the short sellers, but instead of beating up the short sellers, we think we should learn from them. They can trigger events. Sometimes they can be very right, and we see them as a helpful addition to the market. Certainly the attacks need to be dealt with, but I wouldn't expect a whole lot of legal moves on there when a company gets attacked by a short seller to specifically drive the stock price down. Can't really do much about that, but that was a big, big problem last year, of course. But if you go back to Sino-Forest, it was a short seller that brought down a complete fraudulent company, and so there is a place for them. So instead of bashing them and beating them up, just learn from them. Ask what the theme is on your company. If you're being attacked by a short, ask yourself, why is a company being shorted? If you like it and someone else completely dislikes it, then perhaps you should at least know why they dislike it and find out what's going on. They can be very right. Valiant was a nice little example where the short sellers attacked a company and they attacked one of their distribution networks, and then within a month, Valiant closed down that distribution network, and they actually paid $100 million for it, and they just shut it down because of allegations of how they were running that business. And that, to us, that was a pretty big sign saying, okay, this company may not actually be what it says it is. Because if you're a normal company and a normal board of directors, you certainly don't spend $100 million and then shut it down 5 or 6 months later just because some short sellers didn't like that particular business. So that was a pretty big red flag for us. So we like the short sellers because they can give us information that we might not otherwise get. So here's the index breakdown. This is only a couple of weeks old, but if you look at financials, energy, and materials, we have close to 60% in three different sectors, actually more than 60%. So again, it just highlights the fact that Canada is a different type of market. And when we get customers asking us for sector breakdowns, our financial exposure never goes above 20%. So it's almost half of what the TSX thinks you should have in financials. Our energy exposure recommendation right now is actually 5%. Instead of 18, I guess it's probably about 19 now with the difference with the performance of the sector. And our materials exposure, sometimes depending on which client we're looking at, is 0. We've gone much higher in industrials, we've gone much higher in consumer discretionary, and we've gone remarkably higher in information technology. If you look at that chart, a 3% position in information technology is, considering what's happening in the world in terms of productivity, social media, new technology, to have a 3% exposure to that sector, I think is just ridiculous. It's the fastest growing sector almost always. The sector by default, just the way it's run, tends to have exceptionally strong balance sheets. Most tech companies have net cash positions and have no debt because they like to be able to move fast with acquisitions, and they're just historically, investors haven't paid for companies that have had a lot of debt in that sector. And the valuations have changed dramatically. So you can buy a debt-laden energy company for 15 times earnings, or you can buy a company with a lot of cash that's in the information technology sector for 10 or 11 times earnings. And it's just ridiculous in terms of how that has been set up on the TSX, we think. So we'll talk about a company in that sector later on. It's not quite as cheap as some of the other ones, but we certainly like it. And it is now in the sector, so at least people can pay attention to it. So what's going to happen this year? As usual, we don't like to predict, but oil is acting a little bit better. Here's the 5-year performance of oil. It certainly hasn't done very much over the past few years, that's for sure. But we've always talked about the supply response, and if you've been paying any attention to oil and gas producers, every single press release is talking about how production is being curtailed, capital spending is being curtailed, and companies are cutting back and basically hunkering down to try and survive the downturn. So that does create a supply response. It doesn't happen instantly. It happens over 2 or 3 years. But basically, when companies worldwide go from spending $500 million a year to $50 million a year, they're not going to find as much oil go forward. So I think we're in the process of that right now. I don't want to say that oil's not going back to $25, but certainly there will be a response down the road, and much is going to depend on economic growth in the US, which is still a big consumer of oil. So just be careful. Some of these stocks have doubled and even tripled from their lows. We're not quite ready to say, we're going back to $80, and we're not quite ready to say we're not going back to 25. So I think we're going to stay a little bit range bound, but probably a little bit more positive than negative over the next couple of years. Then we look at metals. The chart on metals, that's the 5-year chart, really looks quite bad as well. And again, there's been a big tick up on this. But I want to talk about this for a little bit, because these metal companies in Canada have very bad balance sheets. Teck and First Quantum would be the poster childs for the sector, but they have huge debt levels. And so if there's not a sustained situation with metal prices recovering, these companies, I'm not saying they're going to go bankrupt, but their stock price, which is Teck, for example, I'll just pull it up here, is up 81% this year. It could be a little bit vulnerable if there's not a continuation of sort of the sector bounce. And we took a look at Teck about 9 months ago, and it actually has more debt than it had in the last cycle where it almost went bankrupt. So we're just exercising a little bit of caution here. There has not been really much of a supply response at all here. Most metal producers are actually producing as much as they can to get that cash flow to pay down that debt. So it's a little bit of a different situation than oil, where for almost every metal, at least a month ago, there was too much supply of every metal, and that takes longer to change. And right now, I think the rally has been almost entirely US dollar based. The US dollar has not been as strong as it was last year, and people are taking that as a key to buy metals. And we're just saying, just maybe don't load up the wagon just yet. Have a little bit of exposure, but be cautious, because this rally may not have a whole lot of legs. Again, we have no idea what's going to happen, but that's just our view based on the supply-demand scenario and the dollar picture. So here's the 1-year chart of metals. Certainly from January, you can see it's had a very sharp uptick. And again, if the US dollar becomes strong again, that could be reversed pretty quickly. Gold, of course, again, we don't focus on gold, but everybody likes to talk about gold. That's the 5-year performance. Gold's done nothing for 5 years. And here's the 1-year picture where you can see kind of almost a parabolic move to the upside in terms of the most recent 3-month period. So the thing with gold is it does trade against the US dollar, and it does trade against interest rates. Interest rates in the US are most likely going up at least once again in 2016, and the US economy is actually quite strong. So if you're a longer term gold investor, you might say that's not good for gold. If you're a conspiracy type of money, gold bug type of person, you might say, well, Europe is printing money, the US printed all this money to get out of the 2008 recession, so gold's got to go up because the money supply has gone up so much. We think it's a little bit of both, which implies that maybe you should have a little bit of gold, but don't go too crazy. Like anything else, it's going to be volatile. But after 5 years of not doing anything, it's probably due for a little bit of an uptick, and it's had that already, and would probably put it in a bit of a better scenario than the oil sector right now. Even though some of the gold stocks are up 80 or 90 or 100%, probably the conditions are a little bit better for gold than for energy. But again, if you have both sectors represented, you don't really have to worry about one or the other. You'll participate in whatever is working. 2016 is shaping up to be kind of interesting because Europe has kind of gone all in to try and boost the economy. The US is continuing to carry the world in terms of how it's doing economically. Canada is not doing that great economically, but maybe the trends are in place for a little bit of an improvement. So what really this means is a continuation of more of the same over the past 5, 6, 7 years. And of course, the past 5, 6, 7 years have been low inflation, low interest rates, continued government stimulus, resulting in asset price improvement, and generally okay conditions for the market. May not be great conditions for someone trying to get a job in Portugal or Italy, but as far as the market itself goes, there's still a lot of money chasing a finite supply of assets, and the valuations are decent enough. So I wouldn't expect a whole lot of negativity. Certainly, I don't think we're going to spike up either, but just kind of more of the same, where the good companies will do well. Every once in a while, you'll get a hiccup because of an economic shock, but the actual reality is not quite as bad as people think. So the biggest issue we think in 2016 is slowing corporate earnings growth. So we've had a situation where when we came out of the recession in 2008, 2009, companies cut costs, they cut debt, they reduced everything. They kind of thought the world was ending, and they made sure they could survive whatever is going to be thrown at them. And they come out of the recession, business improves, revenue growth improves, and it was just unbelievable in terms of corporate growth. They had cut all their costs, and so their margins expanded, and the corporate earnings growth was very, very strong, and it set up this nice little rally that we had for the past 8 or 7 years. And now that's slowing down. The easy money's been made, the easy cost cutting has been made, and now it's getting harder for companies to grow. So certainly from an expectations point of view, 2016 is not going to be a good year in terms of earnings growth. The question is, what's the top line going to do? What's the pricing power going to be? Will companies be able to raise prices? You're getting a little bit tighter on the employment situation in the US, so there could be some pressure on costs. Certainly if you can't raise your prices and your employees are costing you more, it's not good for your bottom line if your top line stays the same and your costs go up. So this is probably the most important factor this year. Balance sheets in general are in good shape, but if corporate earnings growth slows more than expected and the Fed hikes more than expected, then that would not be a good situation for the stock market, of course, where growth is slowing but rates are hiking. So the Fed's got to be a little bit careful, but so far, at least as far as what we've seen so far this year, of course the first quarter earnings it's not even over yet, but we don't expect a disaster, but you have to be prepared in case the growth does slow down more than expected. So that's probably the key thing to look at this year, we think. So the Fed, after the last employment number and the inflation scenario, it does look like the Fed will keep raising, but perhaps at a slower pace than previously expected. As I mentioned a couple of minutes ago, that is pretty good for the market. You get this situation where earnings are okay, maybe not great, but rates are low enough to support some of the valuations. And also, probably one of the key differences as well is the credit market is still open. The high yield credit market has had some hiccups, but generally if a company wants to borrow money, they can do it. There's lots of money in the system. And this is quite important. It's so different than 2008, 2009, where all the credit windows were closed and no one wanted to lend anybody any money at any time for anything. That's much different now. Corporations can borrow money. You're seeing lines of credit being increased. And this is financing some of the acquisition deals as well. And of course, if you can borrow money, a company the other day, Premium Brands, they raised money and it had a 4% coupon on the debt they raised. And so, of course, that's tax deductible. So depending on the tax rate, that might actually cost them 2.5% to borrow money on a net basis. They made an acquisition that they think is going to grow their earnings more than 2.5%. It's almost free money for them as long as they can grow it more than 2.5%, and they can borrow at that rate. Then you'll see that continuing. So I think that'll help out the market and help out companies' growth rate, especially when they're buying, if a company's buying a private company with a public valuation as well. So the market's already taken the first rate hike into stride, and guess what? The world didn't end. Investors sort of knew it was coming. I would expect that they would have after 7 years of talking about it. But we've had the first rate increase, and just like tapering, when the Fed decided to stop buying bonds, investors around the world were worried about, oh my gosh, what's going to happen when tapering hits? And the answer was a whole lot of nothing. And I think that was the whole lot of response for the first rate increase as well, just a whole lot of nothing. I think the market's expecting the next one. There's lots of people expecting it in April. I don't know if it's going to happen in April, but there will be most likely another rate hike sometime this year. And again, it's nothing to worry about. I think you'll be okay. The long-term yields continue to fall as well, and that's probably more important for companies looking to grow and looking to acquire and looking to finance. As long as the long-term rates don't go too crazy, you'll probably be okay. So we talked about this a little bit. We continue to focus on industrials, infotech, and consumer discretionary. Talked about infotech a little bit. Industrials is really just a play on the U.S. economic situation and the growth. There's a lot of companies that are benefiting, and some of the Canadian companies like CCL Industries are benefiting from the weak dollar as well. And we also think that industrials might be one of the few areas where there is actually pricing power. As corporations decide to spend again, there is a limited amount of what they can do. And certainly, so again, if you are a company serving an industrial customer and they are spending $1 million, they're not really depending on price. It's more of a strategic move to buy whatever it is you're selling. Whatever it is you're selling is probably going to improve their productivity, and they just want the right product. Price is really less of a factor. And then consumer discretionary is really just playing on a combination of safety and economic growth. If you're really, really scared, you want to have consumer staples, but we think consumer discretionary, there's lots of names in that group. I think that'll be quite fine. So this has not really changed in what we would have talked about a few months ago. Big question for Canada, of course, is the dollar. Our economic outlook is still weaker than the US. Our interest rate scenario is still negative versus the US. And investors worldwide are really still very cautious on the Canadian dollar because they lost so much money last year because of the dollar. That's really going to take a bit of an effort for them to come back in Canada and sort of go crazy in our market. Lots of craziness is going to happen over the next year because of the election. We really don't spend any time on the election at all. It's just a waste of time, really, until you get sort of down to the nitty-gritty. The market is very good at discounting things anyway. The market usually will react 6 months ahead of time in terms of what they think is going to happen in terms of different sectors like healthcare and defense spending and things like that. This one's a little bit different because of Mr. Trump's, let's just say, unique situation and personality. There could be a lot of uncertainty there if he starts looking like the lead runner. But again, until it looks like he's going to win, we wouldn't worry about that too much. Last poll I saw looked like Hillary was still going to beat him. But again, we'll deal with that in a couple of months because there's going to be so much noise between now and then. You really can't do anything about it right now other than turn off the TV. So everybody likes to worry. Let's see, what can we worry about? We can worry about deflation. We can worry about China. We can worry about negative interest rates. We can worry about slower earnings, which I talked about. Unfortunately, terror is not going away, as we saw this week. Profit margins, derivatives, politics. So nothing's new here. And basically, I like to say if there's nothing to worry about, then you should sell everything and get out of the market. So the more there is to worry about, probably the more likely they are to make money, actually, because valuations are reflecting investor concern worldwide. So of those worries, as I talked about, the biggest concern I would have would be slower earnings. It's really all about earnings and interest rates in the stock market. Everything else is really just noise. We're pretty sure we know the interest rate picture. We just need to get a better handle on the corporate earnings picture. Everything else is just kind of background noise. I'm going to go very quickly through this. We'll make these charts available. It's basically talking about the hype cycle and what happens when investors kind of go into a sector and they're all excited about a sector, and then things sort of calm down a little bit and a lot of people lose money. So it's really just looking at what happens in an emerging market trend. So if I go to the next slide, just talk about this a little bit. You get some sort of technology trigger, then you get everyone piling in and they think that the world's going to change because of all this. And then you get a trough of disillusionment, which I love because people realize that not all companies in a new trend are going to make it, and not all companies are going to survive. And then you get the companies that are actually going to make it at the end of the day, becoming the market leaders. So this has happened with cars, with the internet, you name it. And I'll just talk about a few little trends that are sort of making some headlines these days. This is a better chart of the emerging technology hype cycle. I would suggest that anytime you buy into anything that is not kind of a 100-year-old company, like a bank or an insurance company, just find out where they fit on this chart. So if you're buying into a solar company, you want to find out where solar is on the sort of the hype cycle, because if you're coming in at the wrong time, you're going to pay way too much and lose way too much money. And all you have to do is wait a couple of years and you can actually make money from the same company. So a couple of trends, or I guess 6 trends, are drones, internet security, 3D printing, marijuana, virtual reality, and water. And again, I'll go through these very quickly because I want to focus on some questions. Drones, they've been in the news, of course, and there's a few companies you could look at in terms of that market. There's still a lot of problems. I think it's probably a little bit too early, but certainly we don't expect that technology to go away. We expect it to be expanded and its usage expanded, and it's actually quite an effective way of delivering, etc. But we're still in the early days right now, so be a little cautious there. Internet security, there's some of these companies like FireEye was almost $100, and now it's, I think, 17. So we're kind of gone through that disillusionment phase, but certainly as you've seen over the past year and a half with different headlines and the Sony attack and things like that, this is a problem that's not going to go away, and some of these companies might be interesting if you want to invest in an internet security trend. But you could also buy the ETF, which is Hack, and then you just get diversification, so you don't have to worry about which company is going to be the big winner. 3D printing is interesting because it's on the other side of the trough of disillusionment. They had a giant hype of 3D printing. It was going to change the world. Companies were trading at 40, 50, 60 times revenue, and now you're back and reality is set in, and the market's not growing as fast, but it's certainly not going to go away. There's some companies out there that are going to make lots of money, and the ones that survive, which are probably the ones we've talked about here, Stratasys, 3D, Protolabs, they're probably going to do okay. The valuations have changed dramatically, and you've got a situation where these companies can now go forward and look like they're going to make some money in the very near-term future. I had to bring up marijuana because Canada has just gone a little crazy in this sector. You've got a situation where there's dozens and dozens of public companies that are trying to capture investor interest, And even the largest one has only got 14 million in sales. And I'll just give you the market cap here. So Canopy Growth has got a market cap of, sorry, I hit the wrong exchange. It still trades on Venture. $257 million market cap for 14 million in sales. So everyone should just cool their jets on this one, we think. And maybe in 5 years, some of the larger tobacco companies will acquire some of these companies, but right now it's just a frenzy of expectations, none of which will probably be hit. We found it interesting that the Alberta liquor stores are thinking about selling marijuana in their liquor stores. So shows you the advantage of having a good location. But again, I think it's too early. And water is probably the most interesting one. If anyone of you watched the movie The Big Short, this is where all the smart money from that movie is, or from that experience, the housing crisis in the US is going. It's kind of interesting because there's already been takeovers in the sector. It's a problem that's not going to disappear. And we've mentioned 4 companies there: Ovivo, Xylem, Mueller, and Viola. Viola is probably the most interesting because it's a global company. It's much larger, much safer. It's from France. It's not quite a pure play in water, but it's very interesting because they do a lot of desalination, which we think will be a very, very big investment theme down the road in the future. So right now, I'm going to just whip through these. The PE on the stock market in Toronto is 21.5. It's gone up because earnings have gone down, and of course the yield's gone up because earnings have gone down. It's interesting because even though dividends have been cut across the board in a lot of sectors, the dividend yield is still rising, which kind of implies that the market has declined more than the dividends have been cut. So just take that under advisement. Here's the forward PE ratio. Won't really comment much on that other than it does bounce around a lot. And if you look at companies instead of indices, you'll probably do much better than trying to pick which way the TSX is going to go in terms of forward earnings. It's not bad out there at all, really, if you kind of X out some of the problem areas. Everyone, again, as I mentioned, thought the world was going to end in January, and now the market in Toronto is actually up on the year. Of course, that's largely due to metals and energy. But even if you take away those sectors, it's not as bad as perhaps investors seem to think. I think when we were talking to investors last year, it was like, oh, woe is me, everything I own is down. But then if you look at their portfolio, everything they owned was metals and energy, and of course it was down, and they weren't going to make any money that way. So the underlying fundamentals are okay. Again, not great, just not a total devastation. The PE ratio is actually not bad considering how fast earnings fell in the key sectors last year. Even financials didn't do as well as people expected, and as we mentioned, they're the biggest part of the index. But now, and this is interesting, Canada is behind only Brazil and Mexico in terms of the developed markets. It's as we speak, it's up 2.1%. Brazil, with the political situation, is up 13% and 6%. We find that a little bit interesting with Mexico and Canada because, of course, we are benefiting from the U.S. economic growth. So being the neighbors to the north and south, we do benefit from any growth in the U.S. Just walk through there, an economic picture of Canada. The only really takeaway there is things aren't great, but they're not horrible either in terms of the economic picture. So let's get to the fun stuff with some stocks. We'll talk about 7. I'll just skip the sort of intro slides there. So this name is fairly well known in Canada, Alimentation du Couche-Tard. It's actually a very big company. It's about, I'll give you the exact market cap, is 33 billion. But it's up 13% in the past year. It pays a little bit of a dividend. The dividend's been growing. It's got a great balance sheet. It's started to expand internationally. It's made some very, very good acquisitions, including a recent one a couple of weeks ago. And they sell gas, lottery tickets, and snacks. In terms of safety, you can't get much better than that. It's 20 times earnings. It's not cheap, but the company has basically been an outperformer for 7 or 8 or 9 years. And its stability, we think, is very well worth paying for. It's almost one, when we have customers that ask us for like one stock that's got a combination of safety, income, and growth, we almost always go to this company, Alimentation, because it's safe, it's stable, it's proven its growth rate, and the stock's done very, very well, and it increases its dividend as well, which is one of the biggest signs of investment success is when you get companies that raise their dividends. Now, you don't want to buy high dividends, you want to buy companies that raise their dividends. So it's kind of got all the trigger points that we're looking for. It's not perfect. It's got a dual share structure, it's got foreign exchange exposure, blah, 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 but it's just got a lot of good points there. So Knight Therapeutics is much less well known. Some people might have made money on Paladin Labs, and this is the management team that started a new company. And we really like Knight because we like the management team, but we like the fact that the company or the management is not in it for the money. The management team, including the CEO of Knight, made $300, $400, $500 million on their last takeover. And Jonathan Goodman, the CEO, he can only golf for so many days a week, and he might have taken a couple of days off to golf, and then he decided to build a company. And he's a company builder. He really doesn't care what he gets paid. He wants to create another conglomerate. He wants to get people jobs, and he wants to help Canadians on the healthcare side. And so we really like that because he's not going to pay himself a lot of money in options. They're not going to pay themselves a lot in salary. It's all about the stock. And of course, they now own, the management team owns 29% of the company. So they're very, very committed, and that's how they make their money. But the thing we like about it also is of the market cap of 700, call it $800 million, more than 400 million is in actual cash. And as far as the healthcare sector goes, when you've got half your market cap in cash, you're not going to see a Valiant type of scenario where the stock gets cut in half by or goes down 80 or 90% because that cash is there to support it. They've done some very good deals already. They're early stage, but this company's got a 15-year plan, and so there's nothing wrong with an early stage investment if you've got that time frame and you've got the cash and you can support those companies. And sure, some of their investments don't work out. But then what happens in that scenario, what they've been doing is they've been lending out money to some of the smaller companies. If the smaller company doesn't make it, they go bankrupt, guess who gets the technology? And that would be Knight. They roll in that therapeutic technology. They can either sell it, develop it, or partner it up with someone else that's got a stronger balance sheet. And it's a nice little way to kind of grow your pipeline of business with very little risk. Some of their deals are only 5, 6, 7, 8, 9 million. But if they get technology, and they get technology that's been worked on for 5 or 6 years or 10 years even, it's not a bad trade-off. So we really like Knight. The symbol there is GUD. Premium Brands Holdings, that's the one I was talking about earlier with the acquisition. It's a distributor of food products really to places like hospitals and universities. Again, it's not rocket science. They basically slap together a sandwich and sell it. But they do it very, very well, and they've done very good acquisitions. They've raised their dividend. They're now in the index. The stock has actually doubled in a year. But if you've ever paid attention to some of our comments before, we actually like companies more when they double because it means people are paying attention. It means you've got a company that's growing fast and investors are appreciating. In my mutual fund career, I made more money on companies that had gone up than trying to buy companies that had gone down and hoping for a recovery. Earnings have doubled in 4 years. The debt's a bit high, but the cash flow is supporting it. The market cap now is 1.4 billion, which in Canada is about the point you need to get a lot more attention. And when they did their acquisition, very recently, the stock went up a couple of dollars because it was accretive to earnings and just another good acquisition by the company. So we really like Premium Brands quite a lot right now. Magna, I won't talk about that too much because everybody, well, not everybody, but most people know the company. But we really just like the valuation. It's 8 times earnings. Had a very, very good run until recently, but it's really priced for a depression. Meanwhile, they're sitting on a net cash position. They've got 2.8 billion in cash. Their cash flow is 2.3 billion expected in 2016, and of that, about a third of it is free cash flow. So what they've been doing is buying back stock and making good acquisitions. They've grown their dividend as well by a pretty impressive 39% in 5 years. And even with some slowdown expected in the regions of operation, they're still expected to make more money in 16 than they are in 15. So just one of those names where it's a great company, and it's just, we don't think it's being priced properly. Historically, it should get to 11 or 12 times earnings. But if you think about it, at 8 times earnings right now, and earnings are expected to grow, call it 10%, even if they just get back to a historical multiple of 12 times earnings, you could get more than a 50% gain in the stock if the multiple changes and the earnings, come in as expected. So we like the scenario there, certainly for a company that's 22 billion. It's a nice little blue chip, but you might actually get some growthy returns there if valuations change. Kinaxis is one of the newer stocks we've been talking about recently. It is certainly not cheap. It's 36 times earnings, but it's growing very, very fast. It's hard to really explain in a nutshell what they do, but they make it easier for corporations to run their business. So between production, inventory, sales management, receivables, customer service, customer relationship management, improve that workflow across the board. So say if you sell, and you can make sure that you can replace your inventory with raw materials to sort of set it up for the next event, the next big contract. So they've done a very, very good job. It's down 24% this year, kind of taking some profits from its big gains over the past couple of years. But like I was mentioning with some of the with the technology sector comment, it has no debt. It has 99 million in cash. Management knows what they're doing, and they're growing very, very fast, and probably will continue to grow fast for, I would say, five or 6 years before things slow down. One of those nice little Ottawa companies that kind of comes out of nowhere and starts doing the right thing. And we really, really like what's happening at the company, and it's performing very, very well. So not risk-free, not as safe as selling gas and lottery tickets, but we really do. One that is smaller than Kinaxis, but is probably a little bit safer because of the business, is Savaria. And what they do is they make and manufacture and distribute equipment that helps mobility. So as Canadians and Americans get older, of course, we all get a little slower. We all might want to get one of those little scooters, or we might want to get a device that helps us get into our car. They do a lot to help people with mobility. Insiders own 10%. It's growing nicely. The dividend is 3%, and they've raised that dividend a total of 16% over the past 5 years. And it's priced at 19 times earnings. It's a $200 million company, so not for everyone. But we really like the trend. We like the growth rate. We like the management. We like the sector. And so there's it hits a lot of points that I'd like to see. And even as a smaller company, because of the space that they're in, it's probably a little bit safer than some of the other ones as well. And just pulling up their data, they were still making cash flow in 2008 when things were really, really bad. So again, part of the business is the stability, which we like. And then the last one, before we move over to questions, is 10 Peaks. Now this is interesting because this is not a very well-known company at all. But what they do is they decaffeinate coffee in an organic way. So the decaffeinated coffee market is filled with chemicals, and of course the organic trend is moving quite nicely for this company. So they've been growing very rapidly. McDonald's is a customer, Tim Hortons is a customer. Their plant in Vancouver is at full capacity. They're adding another plant as well. And last week they reported earnings, and they weren't as strong as people expected, and so the stock went down almost $2, and investors panicked a little bit because the company has done so well for quite a long period of time. It was up 75 or 80% in a year, and investors saw the earnings and said, okay, maybe this story is over, it's time to sell this company. And so it took a pretty big hit, and it's down 22% this year already. But only 2 analysts follow the company. Their growth rate is still expected to be very, very high, and they're still only at 15 times earnings, yet they pay you a 2.8% dividend. So it's one of those ones where we never like it when investors focus on the short term and focus on one quarter. And especially for a smaller company that is adding a second facility, this quarter is really not that important to 10 Peaks. It's the next couple of years as that new facility kicks in, and as they can grow their base with their existing customers and get new customers. That's really far more important to the success of 10 Peaks. And so we threw it in there sort of last minute because of what happened last week with the earnings decline, because we liked the company before, and it's now 22% cheaper than it was at the start of the year. So there's lots to like it as well.